And that's one KPI that we as a firm measure closely and obviously look at it because it shows us if we are successful as a seed stage investor, helping our companies to get to a very successful Series A. On the one hand, are you good at picking at the early stage? And then are you good in supporting your portfolio companies and the founders you partnered up with? We sit together with the founders in a longer workshop and discuss what are the metrics we should all be looking at Series A. And then we work backwards saying,
Hey, Christian, thank you so much for joining me today.
yeah, thanks a lot, Raul. Great to be here.
Yeah, so is it true that you have like 75% of your portfolio companies graduating to Series A fundraising?
Yeah, that is true. And that's one KPI that we as a firm measure closely and obviously look at it because it shows us if we are successful as a seed stage investor, helping our companies to get to a very successful Series A. And obviously, this KPI has changed over time. If you look at the peak of the market in 2020, 21, this was actually at 100%. So every company managed to fundraise from someone, and it was very easy. Now we're back to 75%, which I think is it's a much more healthy level and where it should be, and it's still far above average. Yeah, but I think that's the one KPI that we look at closely.
So, what is the average? Average is around anywhere between 10 to 20. I mean, from last I asked Perplexity, it was anywhere between 10 to 29.
Yeah, I think the industry average is pretty low, but you also have to see there's kind of many companies that raise a tiny seed round and they call it seed and then don't get to A, or they get bought on the way there. And also in the current market, when more companies are going out of business, that obviously drives down the industry average, which I think is between 20 and 30%.
So, why is your graduation rate so high? Is it because you pick great companies, or is it because of the support?
I would say it's both. I think if you want to look at it from a mathematical perspective, it's probably those two factors actually that define a high graduation rate. Is on the one hand, are you good at picking at the early stage, and then are you good in supporting your portfolio companies and the founders you partnered up with? And I'd say, we're good kind of on the picking side. We spend a lot of time with the founders before we decide to partner up together. And then I think that's also what we're going to talk a lot about today is the partnering. So once we've decided to invest and work together, and we have as entrepreneurs before seen how it is to scale a company, and all our partners at Cherry have an entrepreneurial background, and that does make a difference. So we have been on the other side. We know how it is to scale a company. And we believe helping with our advice in our portfolio that helps them raise a successful Series A and get to the next level.
Yeah. So, between B2B and B2C, is there any difference in graduation? Which one is higher generally?
I would say it's roughly the same. It's just that generally at the moment, there are kind of less. So for us as a firm, we are currently, I would say 90% of the new investments that we make are in B2B. But then also the consumer ones that we do are very successful and raise a follow-on round. I think the metrics that you follow on as a founder in consumer versus B2B are different. And in consumer, it's more about scaling extremely fast, gaining market share very fast. Whereas in B2B, it's more about building the right product and then scaling it thoroughly.
Yeah. Yeah, you mentioned one of the reason for this is also the support. So that's something that I really want to understand more, because you guys have a very structured playbook on how seed funded companies can get to Series A. So starting with the benchmarks, curious to know like how you start off that sort of relationship with your portfolio companies.
Yeah. So look, kind of for us as a firm, like what is important is indeed the success from our seed portfolio to Series A. And so therefore what we do after all the paperwork is done for the investment, we sit together with the founders in a longer workshop and discuss what are the metrics we should all be looking at Series A. And we go through kind of a big kind of benchmark table on, what is an okay result at Series A at a certain KPI and what is a great result. And then we define together where should this company stand at Series A. And then we work backwards saying, okay, if you want to be, for example, at 2 million ARR at Series A, then that means after a year after our investment, and let's say you want to raise 18 months from now, this is where you should be then after 12 months and where you should be after 6 months. And then you can work against this plan. And that helps everyone involved. So the founders, that helps also the whole team in the company, and obviously all investors to be fully aligned on what is the roadmap for the next 18 months.
Okay. So when it comes to these benchmarks and KPIs, right? How did you guys develop this? This is only based on your own investment data, or is it also based on some external reports?
Yeah, no, that is a very big database. So it's also based on external data. It's on our portfolio data. And then therefore we've defined like globally for B2B companies, what is, the top 10%, what is the best kind of companies have seen in growth rate, in NRR, in churn. And therefore, for every specific KPI, we've defined what we believe is the right benchmark, and then we go through those numbers.
So what are some critical ones?
Mm-hmm.
I mean,
Yeah.
I think you guys always talk about repeatability. I'm very curious to know how you measure that. But yeah,
Yeah. No, happy to. So maybe we start with not even a pure number benchmark, because those are sometimes even harder to read. So the number one question is product market fit fully there? So that needs to be visible. We get to that a bit in kind of what exactly that means, but that is, I would say, number one criteria to make sure the company can raise a good Series A. Then I think another one is growth rate. So ideally, a company grows at a 3x kind of year on year, because obviously the company is still at a small scale, so that should be doable. Then what is the absolute traction number? So it's a SaaS business. It should be somewhere between 1 and 3 million ARR. In terms of repeatability, what is it that we want to see is that it's not just a founder who sold to his friends and family and a few people from the network, and that worked well. But then what comes after that, right? So the Series A investor is going to say, yeah, show me that this is repeatable. Like, has someone else sold the product than just the founder? Have you experimented with growth channels? And I think that is extremely important, that a founder can say, yeah, look, it was not just me selling to my own network, but it was other people selling. It was me selling to people I didn't even know before, that I did cold outreach to. I think that is very important at Series A.
yeah, I worked in companies where most of those sales were like just network of founders, and then in the end it blew up.
Yeah, I think it's obviously in the early days, and especially if you have a product that is mostly for other tech companies, or that is, let's say, the initial go-to-market ICP, that's usually easiest because it's shorter sales cycles. All these companies are fast in decision making, and I think it can always be a very good initial go-to-market. But what we want to see is what comes beyond that, and it just can't be a network sales business. It needs to be through other channels as well to show scalability. And then obviously what is also important, and that is another proof point, is the efficiency in this. So what is your CAC payback, which should be somewhere between 3 to 6 months in a good case, can also be up to 12 months if it's more an enterprise product. So depends on like what's the ACV versus CAC. So that all plays a role here. But we want to see how efficient are you in scaling. And can you then also, with more money in the Series A, can you scale this to much bigger levels?
Okay. Do you guys also then maybe look at the burn versus?
Yeah, we look at the burn multiple. So we don't want cash burn to be too high. Generally, it's in some companies, you obviously have to pre-finance your customers. So if the sales cycle is long, that means you need to put more cash to work initially until you get the payback from the customer. Then the other question is, do customers pay a big chunk of that yearly amount on day one, or do they pay in monthly rates or half year or whatever? There's a lot to play around with. But generally, you want to make sure the burn multiple is healthy of a company. And you don't just burn too much money and run out of cash very soon before you actually have fully proven product market fit and gotten to good traction.
Okay, sorry. What is burn multiple?
Mm-hmm. So burn multiple is the way we have defined it, and there's also other definitions from other investors, I'd say, but we say it is dividing net cash burned by net new revenue generated over a certain period of time. Usually, you look at this on a half year basis, and that KPI should be somewhere between 1 and 2x ideally.
So let's say you made an investment. Can you then walk me through like how you sort of establish all these benchmarks with the portfolio team?
Yeah. So I think kind of one very good example from our portfolio is a company called Tacto. It's a Munich-based procurement software company. We led their seed round, and then 18 months later, they raised their A from Sequoia, and then later on from Index. And here, I think from kind of day one, we together defined the roadmap. So, what are good metrics for the Series A? And then in every board meeting, the founders have one slide, which is basically one big table of KPIs. So starting with total ARR, then growth rate, pipeline growth, fully ramped up quota carriers, net dollar retention, ACV expansion, and so on and so on. And then scoring their performance versus the benchmarks. And we looked at this slide every board meeting. And obviously, the more you are to the right side, so to the best result, the better. And it was then very clear to see in every board meeting, okay, wow, we're already good on, let's say, 5 dimensions, but here are 2 where we need to work on. And what does that mean? So, for example, if you're not good at net dollar retention, then let's think about retention. Why are people churning? How can we upsell in the existing portfolio? And then you basically come up with conclusions or very clear measures to work on over the next 3 to 6 months. And that was actually a very constructive, iterative process to get the company to a very good state at Series A.
Okay, so while working with portfolio founders, right, has there been scenarios where you've had difficulties convincing founders to take some of these metrics seriously, or maybe the way the founders interpreted some of these benchmarks were maybe not right? Has there been scenarios like that?
I'd say that the definition of the benchmarks is usually pretty clear. I think and the idea is usually when we develop this framework together on where the company stands, it's individualized and tailor-made to their company. So you actually do have mutual agreement on this is where we want to stand in 18 months. So it's not the framework that we just put on the phone and say, hey, this is where you need to be, but it's kind of jointly developed. So we both agree on this is where we want to be. What can then happen is that a company figures out, I'm deviating quite a bit from my actually desired KPIs. And if I look at my target metrics for after 6 months, I'm 30-40% off. But that also then triggers a very good conversation. And the conversation can be, hey, do we actually have product market fit? Do people really need the product? Or is our pricing actually right? Are we priced too highly? And should we revise our pricing? So it leads actually to very good discussions to then figure out how do you need to adjust your kind of way of doing business and your operating model, and consequently usually then also the targets, because if you're 40% off, it's very hard to catch up on it. But the good thing is it always triggers the right discussions, especially on the metrics that are off, right? So if burn is completely off, then are you overstaffed? Are you not charging enough for the product? Why are revenues not ramping up fast enough? So it's a good trigger point.
Has any team refused to work with you, like in setting up these benchmarks?
No, not so far. It's also we usually discuss this actually before, or like in the meetings before even our investment committee. And when you discuss how is it to work with Cherry, then obviously we say, hey, we have our playbook towards Series A. We're going to help you to raise a stellar Series A. And that is how we usually do it. And so everyone knows that this is coming, and founders actually love it. They want to get external benchmarks. They want to understand how do I get to a very good Series A? And I think since it's an aligned target that you work towards too, it always works well. So no one has ever refused to work with that.
So what are the gaps that you typically find when you start working? What are the areas that you typically go wrong? Like, I mean, some from what I have seen, I have not seen many companies, not have a bridge round or anything like that before raising a
Mm-hmm.
Series A, at least in this part of the world. So, where are the common gaps and where do things go wrong usually?
Yeah. So I would say generally planning is always a little too optimistic. But I think that's also in every kind of founder's DNA. I mean, you want to be successful, so you go for the home run and you're very confident, which is great. I think otherwise you would have a much harder time fundraising, and we want people that believe in what they're doing. So I think that is, it's actually great to see, but you need to know, okay, even if they reach the best case, like or it is very unlikely that they're going to reach this, so you rather discount the numbers by, let's say, 20%, and then it's still an amazing outcome. So I think that is, I would say, a common goal, that everyone is a bit too confident in the initial planning phase. So you got to adjust this a little bit to reality. I think then one gap is that people start to hire a little too late, because if you've come to seed stage, I think a lot has worked through founder hustle, through having a good network. But then when it's about scaling this, you need to hire people, you need to split tasks, you need more people to do this. And some founders just start hiring a little too late and forget how long it takes to find the right candidates, because it can take up to 6 months to find the perfect hire you want to make. So you better start early. And therefore, if you start too late, you're also going to miss kind of your metrics. Yeah, but I think overall, it's actually the roadmap's usually pretty clear. It also includes hiring and team, so you roughly know, okay, I need 3 people in sales, I need 10 in engineering, and then you prioritize that and need to make time for it as a founder, because I think hiring is extremely important, especially in the beginning, because you as a founder are the one that sets the culture in the firm. So you want to make sure your first hires are really good and are a great fit for the firm.
I guess to summarize, all these metrics are essentially answering whether you have, whether can you reach product market fit, and whether, like you said, can non-founders sell this, uh, and whether it's a repeatable process.
Yeah.
Essentially, right? So maybe we can go through each one of them, starting with product market fit. Like, how do you define product market fit?
Yeah. So what we want to see with product market fit is, like, is there a clear need for the product from customers? So do they really need it, or is it just a nice to have, right? So you can also, as some describe it, as vitamin versus painkiller. So is the product really needed? And also, our customers, like, would customers kind of miss the product, right? If everyone says, oh yeah, it's not a big deal if the product's not around anymore, then that is a problem, I think. And then what are early signs to look at it? Because like at seed stage, it's the company is not around for long. So the way to measure this is, are customers willing to pay for the product? If you only have unpaid customers, it's really hard to say, would they also pay 30, 40, 50K a year for this product? So therefore, it's important actually to charge early on. I think you can have the first 2, 3 design customers, maybe with a discounted rate. I'd actually try to avoid too many free trials and pilots, because it just takes a lot of time, and also shows if people are willing to pay for it. It's also, they want to make it work as customers, because they have an incentive for that. So I think that is one. And then the other question is, can also non-founders sell this product? Because as a founder, obviously, your product inside out. Could be you just promise way too much than the product actually can. But if you have other people selling it, it's actually a good test if it works, if they hit that need. And I think then obviously in the due diligence, we as seed investors, but also later on the A investors, they will do their DD on the customer side, and they will ask, hey, is this product generating any value for you? Is it increasing your revenues, or is it helping you on the cost side? Is it helping you on the compliance side? So this product needs to fulfill a certain need The bigger the need, the better, obviously. But if it's just a nice to have tool, that's usually not enough, because then people are not willing to pay for it long term.
I think usage is a very key thing here, right? Like, so I used to sell a cybersecurity product, and then the problem is we could get customers to pay for it, but then they don't use it throughout the year. so
Yeah.
so then the renewal becomes a challenge.
Absolutely. So
Yeah.
that's also why we look at engagement metrics, because there are obviously some products that are not used on a daily basis, because it's just simply the way it is. But then what you want to see is, how is engagement on a weekly basis, on a monthly basis? Is that increasing within the company? Are more users getting onboarded? And the ones that kind of are your initial users, are they using the product more heavily, more often? Are they spending more time on the product? I think that gives you a pretty good indication of kind of the relevance of the product and how it is expanding within a company.
And staying with the product market fit, right? Like, I've read about your nascent product market fit and developing
Mhm.
product market fit. What does that
Mhm.
mean? I've never heard of this.
So look, I think what we see is there are different forms of product market fit, right? So some companies also get there really fast by a product that is very narrow, right? So, and then you have a nascent product market fit. So, there are a few customers that really need it, but then the question is, are there more customers for that, right? So is the market actually much bigger? What we want to see is then, after a year or so, is this kind of a much broader market that you can serve? Are more and more customers willing to get your product? And how long does it take? If it takes you 1.5 years to convince a customer on this product, it's probably not really needed. And I think you want to see a product that is sold fairly quickly without too many interactions, versus one that just drags out, and maybe you're just successful because you're very good in talking people into buying a product, but that is not scalable. So that's why we differentiate between these two different forms of product market fit. So we want to see the real long-term product market fit, and not just an initial one.
Okay. So, but every company starts off with sort of a nascent product market fit when they start off, right? When they have their initial few customers. So, at what point do
Yeah, I
you
would say so.
do you jump over to this developing product market fit stage?
Yeah, like very quickly. Already when we invest, we try to find out, is this, just a kind of narrow product for some customers? Can you actually scale the sales of this product? So it is important that is, not an initial great traction, which can sometimes happen. Or if you have a product that has a big regulatory push, let's say there's a new law that gets put into place January next year, and you have a product for that, then obviously you have a huge run on this product, because you're only one out of three players offering this. But what happens on January 2nd? Then everyone has the product. Maybe you have a few late followers, but then it gets much, much harder to scale this. So that's why we want to see a repeatable sales motion and a proper product market fit.
So, what are the sort of questions or things that you probe the founding teams to ensure
Yeah.
that they're on a path to product market fit?
Yeah. So I think kind of the initial question is, what is your ICP? We want to understand, are founders selling to a very clear customer profile in the beginning, rather narrow one than just going to everyone they can find. And then you need to adjust the product, because this company is out of your ICP because it's way too big. It's actually an enterprise company, and you're actually there to serve SMEs. The next company is maybe too small, so they can't actually really pay what you want them to pay. The next one needs a different feature. That is very hard. So we want them to be very focused on one sector, on one industry, on one specific group of companies in terms of size, to make sure sales motion really works in that bucket. And then you can move on. You can move to other industries. You can move more towards enterprise scale, whatever. I think that's totally fine. But we want to see that you can really nail this in your ICP. I think that is super important. And then ideally you go to the industry that has the highest synergies as the next one, right? So because Some customers also have another business unit in that business. There can be a synergy, or that company has the same kind of regulatory motion that is being put in place. There are different kind of expansion causes, but we just want to make sure you follow to the one that is easiest for you given where you are today.
Okay, with seed round, you need to prioritize really well, right? Like, so sometimes one issue that a lot of products have is that, okay, you might have a couple of customers and then they would want custom features, and then you have to do custom build stuff.
Mhm.
So the prioritization, is that something that you look at? That is one thing. And also, like, how do you assess defensibility? That's a second.
Yeah. So I think on the like on the first point, totally. I think you want to see a founding team that sells one product without offering in every sale, oh yeah, sure, I'm going to build this feature for you, and for the next customer, you promise them another feature that you're going to build in a year. So that is not very scalable and gets you in a very tricky spot, at least after a year. Because then your customers figure out that you actually don't have all these features, and that just doesn't make any sense. So we want to see that you can sell one product. Obviously, we want to also see that the founders can dream about the future when the product is much bigger, has much more features, much more use cases. I think that's amazing. But we want to make sure you can sell the current product, because otherwise it's not going to work. Then in terms of defensibility, yeah, we want to see defensibility actually in the product, because defensibility is not going to come from you're the best salesman and you're the fastest to sell it. It needs to be embedded in the product. And this can be because you have a great data set that you're building on, because you get like interesting data from your customer that no one else has. Maybe you mix that with external data. You put an AI layer on top of it for decision making, suggestions, whatever. But I think that is something that builds defensibility, and we want to see something of that. Otherwise, kind of everyone else can copy your business, raise more funding, outperform you maybe in sales, and then you have an issue. So we want to see a real moat in this business that is usually within the company, and in most cases either comes from a very complex software that you've built or from a very strong database that you've built up.
So I know a lot of companies cannot replace a lot of these enterprise software because of this data mode. Like, but as a startup, like, how do you get access to it?
Yeah, I think, in enterprise, first of all, it's harder than in SME. I think in SME, it's always a bit easier because the market is moving faster, so you can do more. Look, the way we look at this is, I think in today's market, there's lots of external data available that you can get. Plus, through recent developments in AI, actually, you can do very interesting stuff with this external data, plus kind of the internal data you get from your customer, and then maybe also from other customers that you can use. And I think that makes it very interesting. Whereas the incumbents are probably a little bit slower, maybe they don't integrate so much external data. They are probably still very much in a silo mode. So they have the data for one customer, they work with that, rather than working with a bigger data set from all other customers they have. So I think that is your advantage, that you can create much more with the more data you have and being more agile than an incumbent.
And you briefly talked about the ICP and stuff like that. But like, what are the sort of principles on like creating a great GTM strategy?
Yeah, look, I think what we want to see on go to market is, first of all, like a very clear current product and a product vision. So, this is the product now, this is where it's going to be. So that's very clear for the customer, like what is he or she buying today, and what can this also do in the future. And I think most importantly, what's the value add for that customer, right? So just a nice software to make your workflow a little bit easier, that's usually not enough. So if kind of the main value you bring is cost savings, I think you need to make a very clear case. Okay, this is a sample customer where we save that customer 500,000 or 1 million in spend each year. I think that is important, and that helps you a lot. If it's a tool that goes more to the revenue optimization, you can show, hey, with this other customer, we increased their revenue by 10% just by using our tool. So it's an amazing product to use. I think that is extremely important, that the founders can pitch their product well, and also that others can pitch their product well to their potential customers. And what we want to see in go-to-market is that there's a clear kind of growth channel view. So what are other growth channels? Where do you get your leads from? What are the best sources? How big are these sources actually? So are you done after half a year, and then every potential customer in your market you have already reached out to, or are there other pools of leads, and how can you access them in the most efficient way? And this can be all different types of growth channels. There's no right or wrong. For some products, webinars work amazingly well. For others, it's just cold outreach via LinkedIn. For others, if it's more enterprise, it's trade fairs. So you have to figure out like what is it that works best for your product. There's no kind of right or wrong. You need to figure it out, give it a personal spin of kind of what works best. And then, ideally you find those 2-3 channels that are working really well for you. And then you double down on it. You put more money behind it, more resources behind it, and scale through these channels.
And what are some of the metrics to track to see things are working or not here?
Yeah. So I'd say in go-to-market, I mean, the obvious one is growth rate, right? So are you growing? Are you getting to at least 3x growth year on year? If you're only growing like at your early stage, if you're only growing 50, 60% year on year, you probably haven't figured out like what's the best kind of growth channel, or have you built the product the right way that people really want to have it. So I think growth is probably the best indicator for it. Engagement in the product is important to make sure people are really using it and are not just buying it and then they drop out after a year. Obviously, net dollar retention is important. So are people expanding with a product? If that is above 130%, amazing. If that's below 100%, you have a problem. So I think those are KPIs to look at. They actually give you a good indicator.
And you mentioned you need to be very clear on whether your product is either saving the company or maybe revenue optimization and things like that. So, okay, let's say you're saving the company $500,000. Then how do you then price your product?
Yeah. So, yeah, in the end, I would say early stage pricing is rather an art than a science, right? So, because theoretically you could say, hey, I save you $500,000, so pay me $500,000 because in year 2, it's already an amazing deal for you as my customer. I think that doesn't usually work because initially it's also about kind of, getting traction, getting first customers on board, sometimes making a compromise. So I would price it in a way like look at similar tools that add similar value. So for example, if you really save $500,000, you can also easily charge $100K a year for this, right? I think that is pretty clear. But I think in the early days, I would make sure to get into the customer to prove the value, because usually you've proven that value with another customer. So there's still a little bit the question, does it also work with me as a new customer? So prove that, and then I think grow from there. Generally, I would say most founders are not aggressive enough on pricing, especially in consumer. Everyone thinks, oh, if I raise my prices, every customer is going to go away. Turns out, actually, in almost all companies in our portfolio, you could raise prices by 10 or 20% without any kind of customer dropping. So I think in B2B, you need to be a little bit more cautious, because if you have one big client, you increase the price too much and the client drops, that hurts. But once you're a little bit bigger, I'd really recommend to experiment on pricing and see how far you can get. And usually you're pretty surprised how much you can go up with your price.
Yeah. And especially if you develop some data moat or some sort of dependability, then you can you have more leverage. Yeah. So what is your opinion on like giving out maybe free features or things like that as a trade-off for receiving data or understanding workflows?
Yeah. Look, I'd say first of all, it's important that you gain traction. So therefore, I think do whatever it takes to get there. The only thing is, if you give out the product for free, the problem is you miss the real proof of product market fits. You don't know if they would actually also buy it if it was 50K a year. Therefore, I'm not the biggest fan of kind of giving out the product for free. I wouldn't do too many free trials. I think in the very, very beginning, so pre-seed stage, you need 3-4 design customers. Yeah, whatever, do it for free. Ideally, you charge a bit for it. But then I would quickly get to a point where you charge and then you see if it's working and if that is scalable. There's some customers, some companies that need to build out kind of this database first, where actually it's more about getting this data initially and less on monetization. That can also work. And then you charge later on. But it can be a quick excuse for founders to say, no, I need to get these customers to get the data to get better. And then I start charging in 3 years. But then in 3 years, you probably have run out of money. So therefore, we actually encourage everyone to start charging early and see how our customers pay for it. And if your product adds value to the customers, why would they not pay for it?
Earlier, you mentioned that one of the mistakes that you see a lot of founding team make is that they leave it too late to hire. So curious to know, what is the sort of composition? How important is a team in getting a startup from seed to Series A?
Yeah. So look, I think at our stage when we invest, so early stage seed, I think team is extremely important. So we want to see a complementary team, ideally. Yeah. So one founder very strong on the commercial side, one founder very strong on the technical side. If we then have a third one who's extremely strong in product, amazing. I think it also works if you have two founders, but that would be kind of the perfect setup. And then once you go over to Series A, I think you want to see kind of that this team can hire and attract top talent. So can they hire a top C-level with AAA candidates? Can they attract them, get them on board, get them equally excited about the company, about the product, about what they're building? So this is also then what Series A investors look at. So is it just the two founders, or have they actually built a proper company and a very good senior level to then scale it from A to Series B? So this actually becomes pretty important. Depends a bit on where do you start off and where are your strengths at seed and what do you need to add. Usually you need to have someone who does finance for you, so it shouldn't be the founder still doing kind of the financial side, sending around the monthly report, all of that. So ideally you hire kind of a VP finance or CFO, depends on kind of the seniority of that person. So just to take away that burden. Then I think many founders hire a founder's associate who can take over a bunch of tasks. That usually works well. And then obviously kind of, you need a very strong engineering team, ideally a very good VP engineering that you have already, or at least a very clear candidate that you would then hire after the Series A. I think that's kind of what Series A investors want to see.
So what does the team size and org look like at seed, and how does that transform in Series A?
Yeah, I would say kind of at seed, it's usually between 5 and 10 people.
Yeah.
And then at Series A, I would say it's between 20 and 30. If it's B2B. In consumer companies, it can be more. But I think that is also usually a good size. So I think because, as I mentioned, the burn multiple needs to be in line. If you have more than 30 people, that gets already pretty tight. So if it's like 20 to 30 people at Series A, that is actually a good size.
And the split among sort of maybe product and distribution?
Obviously, always depends a little bit on, how thick is the product you're building, how complex is it. But I would say ideally it's like two-third on the kind of on the product tech side and 1/3 on the commercial side. But we've also seen 50-50. I'd say that is roughly the range we're seeing.
And the team's ability to hire the AAA talent that you talked about, like how do you judge that?
Yeah, I think the good thing is, as an investor, you also usually touch base kind of with the rest of the team. So when there's a board meeting, some of them come in and present some parts. And then there's usually a board dinner or lunch afterwards where you get to meet them. So that's always a good point. Then also when the team is recruiting, we usually help in interviewing the top talent. So we're usually involved and get our own view on on the candidates. And I think that gives us a good view. Then for the Series A investor that then looks at the company, they do the same. They interview the C-level and form their view afterwards. If they feel, okay, wow, those are really top caliber that they attracted, or if they feel they could do better. I think they're also very good in assessing that.
And another thing is the finances, right? At the beginning, we talked about burn multiples and things like that. So, what are the metrics maybe that the teams don't look at really closely, in your opinion, or in your experience?
Yeah. So I think the biggest mistake is if you only look at growth rate, and if that growth rate is not even based on revenues but on like user numbers, that leads to completely unaligned incentives. Because if then in the firm you tell your whole team, hey, it's all about user growth, then they get a bunch of users in that are not paying for it, that are just there maybe to try it out on day one, and then they all drop. So I think it's important that kind of you look on real growth, so revenue growth, and then that you don't forget to look at the efficiency of that, right? So if kind of that revenue growth comes at a massive cost, you probably haven't really figured out a great go-to-market motion. So we want to see that you scale nicely with a moderate burn. If you look at absolute numbers, I would say if a company gets to Series A and let's say they are then at 2 to 3 million ARR, ideally they're not burning much more than 200 to 300K a month. If it's more than that, it's actually either the team is very overstaffed, or maybe the product is not there yet and they need to kind of hire many more people to fix issues. But ideally, like it's healthy if you're then at like 200K burn. I think then you're in a pretty good spot.
Yeah. And when you raise a seed, usually you raise for 18 to 24 months, right? Like, so,
Correct.
and we discussed now a little bit product, the GTM, hiring the team, finances. So, if you were to put this on like a timeline, okay, at the 9 months or 12 months period, time period, where should the product be? And then maybe we can also discuss all the other
Yeah.
stuff.
Yeah. So look, I think starting from product, look, I think if after let's assume there's a company that has raised a pre-seed round from angels, comes to us, raises, let's say, a 4 million seed round. So, it has actually quite some money in the bank to then build out the product further and show initial traction. So ideally then after a year, this product is working properly, right? So customers use it on a daily or weekly basis. They love it. They feel like, yeah, they're like, we'd love this feature at some point, and we feel, hey, this could be built out further, but it's kind of the current product actually serves them already quite well on what they need. So I think that is what you want to see on the product, and that that you can sell it fairly easily, and also onboarding with the product works easily, so that you don't need lots of manual effort in onboarding the customer and do lots of hand holding, migrate that data, and spend a lot of time with them. Ideally, all of this works almost automatically. I don't want to say self onboarding because that's what everyone wishes, but it's usually not that easy. But you want seamless onboarding. And I think then you're in a pretty good spot on the product side. If you look at the kind of monetary side after a year, and let's say you want to raise in 18 months, I'd say ideally you are at 1 million AR or close to it, and you got there by growing 3x. And I think if you then grow another 3x from there, you'd be at at a very healthy top line traction when you raise your Series A.
But at what point do you start planning? Because you need at least 6 months, right?
Yeah.
Runway sort of thing. So you
Yeah.
start planning for the Series A at the beginning of 12 months, or?
Yeah, I'd say so. So after years, usually the good. So the like when we invest and make this plan, idea is to have 24 months of run rate, so 2 years, to raise ideally after 1.5 years. And then after a year, that's when you say, okay, numbers look good. Let's prep for the fundraise. Because also, you need to prepare your materials, have all your cohort data right, and all of that, which takes a little bit of time. And this is usually also just held with 2-3 people in the company. So that's why it's still lots of founder work that goes into the preparation of the Series A. So it's not that you have a CFO that's done this already 5 times and you just hand it over, right? So you're not at that stage yet. So you have to do it yourself. You craft the equity story. What is it that I'm going to pitch the Series A investor? And I think once you have that clear, you execute probably another 3 months towards your plan, and then you go out. And ideally, then it's a 2-month process to define, who's the lead you want to go with, and then maybe another 4 weeks to close the round.
What if things are not going well at 12 months?
Yeah, good point. That can obviously happen. Yeah. I think then most important is to be very honest and transparent kind of with everyone around the table and figure out, okay, why is it not working, right? Because it's evident. If you're not at a million ARR but you're at 500K, then it's a fairly big gap, and the question is, why is there a gap? This could be because sales cycles are much longer, or because there is suddenly a big competitor that came in, half their prices, which is an issue for you. So I think then we want to have the right discussion about it, and I think it's also, I think all founders are actually very transparent in these phases, because it doesn't help you to come up with excuses and say, yeah, look, it's just like it's recession and macro is difficult and all of that, or seasonality. I think if you're a startup, seed Series A stage, seasonality shouldn't really matter for you. You should outgrow seasonality because you're young, your numbers are still small, so you should be able still to close customers in a more tricky period of time. And then we sit together, figure out what is needed. Do you need to tweak the product a little bit? Is maybe your ICP not really wanting the product? You need to go to a different target group. Sometimes founders discovered, hey, maybe this initial kind of market is actually not the best, or I want to go more enterprise, or I want to go to this different industry. They seem to need it more. Totally fine. I think you need to course correct. I think worst case is founders just stay on their lane all the time until they run out of money. I think that's the worst to do. So, and we see top founders, I think pivoting is always a hard word because it means you're doing something completely different. It doesn't need to be the case in all these scenarios, but it can be, hey, I flip around my product because I feel this is much easier than to sell, or I slightly change my ICP and it's much easier to do. Totally fine. We want to see this agility and dynamic behavior, because it doesn't have anyone if you've stayed always on the same path and not deviated a little bit to left and right, but then you run out of money with horrible numbers.
Yeah. So when it comes to your own portfolio, how often do you have these conversations? Like maybe with what percentage of your portfolio companies?
Yeah. I think, look, from the outside, it always, if you look then at the bigger companies, it always looks like, wow, everything went amazingly well with this company. And it was always up and to the right, and never anything happened. I think the reality is, also from being an entrepreneur myself, I think every company goes through very, very hard times on their journey when it's about, wow, we only have very little cash left. We need to act immediately, or suddenly growth stopped. We need to change something on our go-to-market, or even worst case on our cost side. So I think it actually happens very frequently that there's something you need to adjust to. So that I would say we probably even see in 80% of the companies, and also in the ones that are now multi-billion-dollar companies. It's never a straight line. And I think good entrepreneurs need to weather those storms and be quick and adjust to new situations.
So the couple of things that we have not talked about in terms of timeline is, like, at the end of a year, what is sort of the GTM and maybe the team composition look like?
Yeah. So ideally, by then, it's not just the founder selling the product, but it's ideally a team of 2 to 3 AEs kind of that are selling the product. And ideally, let's say if you have three, two of them already ramped up, maybe one already fully ramped up, the second one in the middle, and the third one maybe just started. But you want to see, how does the ramp up curve look like? Can other people sell this product? I think that is clearly what you want to see. And then on a bit more kind of top of funnel, it depends a little bit on the business, but ideally you see kind of a marketing team that helps you generate leads. And yeah, so that you have a proper kind of sales engine up and running. And that is not just kind of one founder selling the product. That is just not enough.
And this is at 1 year period.
Yeah.
Right. Okay. So you have a plan with a lot of metrics, and somehow the company is hitting all these metrics, but you also need to still tell your story, right? To raise the
Absolutely.
next round of funding. So how do you guys help with that? And what is that process like?
Yeah. Yeah. Look, this is super important, right? So when a founder raises the Series A, it still relies a lot on the founder. And I think therefore the equity story needs to be very good. Obviously, kind of your numbers speak for themselves. So I think that is clear. But I think you need to be very good in articulating an exciting story why the next investor should invest into this company. Because every investor at Series A stage, also at seed, I mean, sees so many companies and there's only very, very few that they pick in the end. So you want to make sure kind of you're very good in articulating your vision and why this becomes a billion-dollar company. I think generally US founders are stronger in this dimension than European ones. I think European ones are usually very humble and don't like to pitch the big vision because they're not there yet. But I think it's important to show the potential of the company. And then I think the story needs to be very crisp. Like, what's the why now? What happened in the market that this is now a great opportunity? What are you building? Who's your target customer? What's your traction? Something like, hey, I got from 0 revenues to 2 million ARR in the last 18 months. We're growing fast. Our pipeline is massively filled. It's a blue ocean market. It's X billion-dollar big. And it's projected to grow another 30% year on year. So, we are there to win first kind of the market in our country and then later on globally. And I think that is what investors want to see from this team. And I think that is extremely, extremely important.
What do you think is the most important thing when it comes to telling a story? What sort of framing works the best?
Yeah.
Maybe what is the factor that will really push the investor to say yes?
Look, I think it's obviously numbers don't lie, right? If you have outstanding metrics, that is the best basis you can ever have, right? So ideally, on this KPI metrics, you outperform in 70-80% of the KPIs, right? So that makes you already a top decile company of your cohort, right? So huge advantage. And I think then it's about articulating how do you get from here with excellent metrics to the next level and to the one after that? And why is that an exciting space in which the next multi-billion-dollar company is built in? I think that is what you need to convey. And that is what then gets funds over the line. Obviously, one secret, like if you have more than one term sheet, it helps, right? So if you can say, hey, I have excellent numbers and a great story and already 2 term sheets, everyone moves a little bit faster.
Yeah.
I think getting this first term sheet makes a big difference in your fundraising trajectory.
Yeah. I think that's the only thing to speed up the things. If you have multiple term sheet, yeah, you have
Yeah,
negotiation.
that
Otherwise,
always
the
helps.
opposite party has a negotiation power.
Yeah. And I think on the other hand, as a founder, also don't overplay your hand, right? So we've seen founders telling funds, yeah, I already have term sheets, and they didn't have one. And that always comes out and then it bites you, right? So I think there you need to be very careful, like always stay to the truth. I think there's nothing kind of in winning it by overplaying your hand. And also if you say, hey, I have a super high valuation from fund X and you've named that fund, I mean, it's super easy for every fund to figure out if that is true, because everyone knows each other in our industry. So don't underestimate that fact.
Yeah, you said numbers don't lie. So what does really good numbers look like? Just to summarize.
Yeah. Look, so I'd say for for a stellar B2B company at Series A stage, so I'd say ARR traction around $3 million, really, really good at your upper end. I think growth more than 3x year on year, perfect. Late stage pipeline growth. So investors are definitely going to look at your pipeline. So can you sustain that growth, or is everything going to collapse after the investment? So ideally, you can show that you have massively increased the pipeline and that you have found kind of a motion to continuously increase your pipeline also by 3x. Fully ramped up quota carriers. So do you have people in the sales team that can sell this product going forward? Ideally, also more than 3 people. Net dollar retention, I would say.
Sorry, what do you mean by fully quota carrying AEs?
So that means kind of salespeople that kind of fully fulfill their sales quota, so their sales target. For example, if it's a SME SaaS tool, let's say you charge 30, 40, 50K for that product a year, and that salesperson should make a target of 700K a year, right? And we want to see that you have 3 of those that are already at their target or on their way to that target. So you have a good feeling of, hey, wow, this is really repeatable. And if I hire 10 more of them, I'm going to add 10 times 700K ARR, right? So which then gets very juicy numbers. And I think that is what you want to see at Series A. Then net dollar retention, obviously important. I think there at Series A, I'd say everything above 140% is really, really good. I mean, we've seen companies with 200%, but that is really, really the exception. ACV expansion. Can you expand ACVs over time? Ideally, you can expand them by more than 50%. That's amazing. Repeatability, strong. Can you repeat your sales process? Great. CAC payback, we talked about this beforehand. Ideally, 0 to 6 months. You're absolutely top quartile. Burn multiple, we discussed somewhere at around like 1 to 2. Unit economics, I mean, if it's a software product, you usually do have good margins, but they need to be high, important. Not the case for some of the AI companies. So that's why you got to work on this margin story and make sure if you don't have good unit economics now, what is the clear path to very good unit economics? And then product market fit. But I think product market fit is then demonstrated by all of these KPIs. And look, if you now go through all of these KPIs, chances are close to 0 that you're excelling in all of these dimensions. It's not going to happen. Yeah. But look, if you're very good in 80% of those cases, you're going to have a very good time fundraising your Series A.
That's a good note to end. Yeah. Great. Christian, this was great. Thank you so much for taking the time to do this.
Yeah, thanks so much. It was a lot of fun.